Hey everybody, welcome to this free edition of our Trader News Report Weekly Roundup. This is for the trading week ending July 31st, 2020, the end of the month of July. I'm Preston Brent. Thanks for tuning in. Well, remember, don't be a brat brain trader. You want to be the red striped zebra, and this week's theme is La La Land. So let's get started here. Let's take a look at kind of where we've been this week. So if we take a look at the indexes, a fairly decent week. As you can see, the Dow just basically below flatline for the week. Year to date, it's down 7.39%, along with the Russell, it's down 11.27%. But the other indexes, both the S&P made it above in the green, and for the year to date, also in the green. Nasdaq obviously had a very strong week, up 3.69% year to date. Very strong, just slightly under 20% for the year. A little bit more than halfway through the year. Amazing, just very strong performance, no doubt. We'll talk about in just 1 minute. If we take a look at the sector performance, you can see here that the best performing sector, of course, was technology, up over 5%. Worst sector this week was energy, down a little over 1.8% for the week. And then, of course, if we look around the planet, we'll see across Europe, most of them were down a little bit. Nikkei was up just a little. China's down. Hong Kong Hang Seng Index was down just a little bit as well in the Asian markets. Of course, if we look at valuations, the trailing 12-month PE is at a whopping 31.9. And the forward PE ratio for the next 12 months is still pretty strong, coming in at 25.45. So the forward PE is about 20% less than the trailing PE for 12 months, but still very elevated. Of course, one of the main reasons why is we've got the S&P dividend yield still around 1.9% with the 10-year Treasury ending the week at 1.536%. So that gives us a spread between the dividend yield and the S&P and the 10-year around 1.36. So naturally, money is just going to want to flow into the U.S. markets. I mean, that's only natural what we're going to see here. So if we kind of take a look at the weekly sound bites for this week, let's start off with technology, as I mentioned. What I call the four horsemen of technology: Amazon, Facebook, Apple, and Google. Although Microsoft should really be included as well. They exceeded Q2 earnings expectations, and we saw three of the four, Amazon, Facebook, and Apple, moving up dramatically. I mean, really, when you look at it, we've seen Q2, is the best of times for these tech companies and kind of the worst of time for many of the other companies. And the U.S. consumer is kind of held together by the CARES Act. That's the U.S. fiscal package that is already out there on the table with a total of about 2.3 trillion to kind of help bridge this income gap from being unemployed. Currently, the Dems and the Repubs are really far apart on this new fiscal package, but we'll see where all of that kind of comes in. Somewhere between the Republicans wanting 1 trillion and the Dems wanting a whopping 3 trillion. So we'll see where this settles in. But speaking of the consumer, even though the consumer wages and salaries plunged an annualized rate of about 680 billion this quarter, the CARES Act has really helped drive personal income actually up over 1.386 trillion. So this CARES Act is very important for the consumer and the economy and spending. So we'll see how all of this shakes itself out. Okay, but I believe they're going to get something done here soon. Like I said, earnings beat dramatically up from Q1. So far, we've seen about 300 companies, the S&P report, and about 85% are beating Wall Street expectations. Now, keep in mind, and they've been beating them by an average of 22%. That's a record beat, and it shows because we've got very low expectations. It's all about expectations, folks. And as long as the expectations are very low, then it's very easy for companies to beat. So we've seen most analysts just really not knowing what to expect in Q2. But they're just beating them by an average right now, the 300 companies, by 22%. Now, as a point of comparison, with Q1, we had about 70% of the companies beat estimates in Q1 by an average of about a 3%. So it's kind of solid for basic historical purposes, but compared to Q2, everything is out of whack. Many of the other large cap stocks from manufacturing, auto sectors, and so forth have been lagging their technology brethren. So we're seeing that in the markets. which has moved the markets up, but it's led by a smaller and smaller supply of companies, i.e., the four horsemen and a few other technology companies. So the breadth is getting fairly narrow at these higher levels here. Of course, the economic data came in still mixed, but we saw Q2 numbers come in with a whopping negative 32.6%. Really amazing, right? 32.6% negative. This is the largest drop since records started in 1947 here in the US. But, making sense of these numbers, in my mind, is almost impossible due to the forced nature of this economic showdown. I mean, it's really difficult. And we saw Friday, the US, we retained our top AAA credit rating from Fitch, but they did revise the nation's credit to negative, believe it or not. But it still got AAA. Okay, so you probably didn't even know it just by watching market price action move around and then finish strong as we rounded out the month of July. So thus far in Q2, the U.S. has pumped a little over 5 billion into the U.S. economy, right? And when you compare it to our nominal GDP of Q2 of about 4.85 billion, we put in more money in the U.S. economy in the shortest period of time in history, but more than the entire quarterly output of GDP. So that just shows you. I mean, the markets very hard to go down when the U.S. is putting that kind of money into the markets. But eventually, we're going to have to pay the piper. I mean, we see the yields on the U.S. Treasury, as I said before, they closed this week at 53.6 basis points. It's a little over 0.5%. Really very low. So it shows the debt markets don't have a lot of confidence in the near-term future of the U.S. economy. We're also seeing portfolio hedging costs higher and higher. So, a question I get on some of my buddies that are in hedge funds and some mutual fund organizations is, what do they do? Do they hedge their fear? Like buying puts and things like that, which can be a pretty good drag on the portfolio, or do they buy fear, meaning they allocate money to other underperforming assets and value companies and things like that. And we're seeing a lot of buying of fear where they're buying into underperforming assets, financial institutions being one. Okay. Now, the other thing that we've seen this week is the US dollar has just come under major pressure against a basket of currencies. The US dollar is just fallen big time. The euro, which is about 57.6% of the US dollar index, has moved up dramatically over the past 4 weeks, mostly on the expectation that the European markets in 2021 will be stronger and come out of the pandemic much faster than the US. So we're going to see some of this play itself out. And then, of course, with the EU and their agreement on their historic stimulus package, that's going to further accelerate, I think, the euro based on the way that package is put together over the dollar over the near term. But I think the dollar is finding or will find a bottom shortly. I'm not in the camp that the dollar is going to go much lower, although it could, near term momentum carry it down a little bit, but I think it's going to start to stabilize shortly. What I want to do is let's take you over to the charts, right? That's kind of what you guys want to see. So let me move you over here. As I do this, we got a hurricane getting ready to blow right through the area here. I'm looking at the beaches, although I can't see the beaches now with the strong wind and rain and coming through here. So, but let's take a look. What I want to show you here is the E-mini S&P 500 futures. I'll let the screen paint for you. And when it comes up, you're going to see I've got some fib node. These fibs are extensions off the lows. You can see here we made new highs. We're in the green. We're above the blue line, which is a closing price of 2019. You can see over here the purple is volume over price. So you can see dramatically a tremendous amount of volume right below, which would be represented as buyers. There's just a big fight going on right now with the buyers and sellers as it's trying to hold this price action up here. And you can see my target for this LAOA 5 is sitting right around 3306. So call it just slightly over 3300. You can see that we've got a solid cross in the 50 over the 200. This is a simple moving average, not exponential. But we did call out, I called out back about 10 days ago, a little bit more than 10 days ago, I called out some puts for our members because I saw a setup with a put and we played the downside here. And I still am not entirely convinced yet. Neither is the market that we're going to run up. We need to see a little bit more of some support in this area here to get some higher movement in price action. But you can just see here the area that I'm harping on with our members, and it's a really key support area, is right in that area right there, which is sitting right at 3,200. It's a psychological number, and if I were to extend it out like that, you can see how all this volume over price is just sitting right between the red green year to date performance line 3236 and 3200. So even though we're sitting here and we closed at 3269, you can see these are bullish candles here where buyers stepped in as price action came down. And it's just the opposite of these candles here. I'm going to expect some resistance right at this level up here. So let's kind of see where we go from here, see how price action shapes itself out. 33.93.75 are the all-time highs. If we can clear this and hold it, then we're going to definitely make new all-time highs at 3,400. And you may be saying, well, how the hell can we do that with a GDP number coming in, as horrible as it did, right? Coming in at that 32.6 level. I mean, just really, really horrible. And remember, the financial markets and the stock market is not the economy, and the economy is not the stock market. Stock market trades where it believes the economy is going to be 6 months to 9 months in the future. And even though we've got very high PE ratios right now, when interest rates are sitting at 53 basis points, then it has a tendency to drive PE ratios up dramatically. So that's what's causing this effort here. And if you remember from about 4 or 5 weeks ago, when we cleared this level right here, actually when we cleared the 61.8 fib node, then that told us historically, looking at bear markets, when we were in a bear market, that we're not going to make new lows, right? And we've just been moving up here. And I got our members mostly bullish in early April. Okay, I mean, if we look at the markets, let me just move these. I'm going to move the chart around a little bit so I can show early April here. Let me just do this kind of thing like this, and let's just show you where we've been. And if we look at early April right here, right in this area here, you can see volume over price. The most volume over price is sitting here right at about 32.13. That's kind of an equilibrium point with volume at that level. So that would obviously, and you can see the bottom of the candle here on Friday's close, we came right down to that level, and then buyers just stepped in, driving price action back up. Okay, but we've been bullish, really going through early April, right? Right in this area right here, we've been very bullish, and we had the signals to go bullish, so obviously we wanted to. And you can see where the fib extensions off the lows just kind of just propelled us higher and provided really solid support for us. And if we look at Nasdaq, I'm going to put Nasdaq up here on the screen. Here we go, right here. Now with Nasdaq, it's just the opposite. I've done retracements off the highs. And with Nasdaq, with tracements off the highs, if we go back to early April, you can see all this volume here is sitting right in this area here. So that's going to provide support for us right around 10.6. My original support area was around 10,000 when we were pulling back here. You can see the volume here sitting on that fib retracement node. We're not at all-time highs. I mean, last all-time high we made in Nasdaq was on July 13th. It's trying to make it up, and just looking at all the chart and price action, we could get a quick move up and then a roll back over again. And if the four horsemen, that would be Amazon, Facebook, Apple, Google, and then let's add Microsoft to it, start to show a little bit of weakness, and that's going to drag everybody else down just a little bit. Okay, so these are just some of the ones that I'm looking at. And if I put it back on the E-mini, and then I'm going to put it over to an Ichimoku cloud chart, and you can see here on this 240-minute chart, because this is I like this time frame because it's a good intraday. I call it the X-ray view of intraday. You can see here how this green cloud just provided great support. We didn't break through it, and even when we shifted over to red, which suggested a break to the downside, we're still above, so it's still bullish. And a potential target down here was around 31 and some change, 31.40 area down to the 31.35 as far as downside support. But if I put it on a daily, it's going to shift this view a pretty good bit. And you can see on the daily, you can see here where we took out this prior pivot high here. We've got the bearish divergence, beautiful setup to the downside. We've pulled back, and now again, same as the other charts at 3,200 sitting up, but we've got some support right here. We've got the green cloud below us, which is going to provide larger, longer term support. So if we do get a pullback, it's not going to be it. We can see vol come up a little bit, but I don't think it's going to be too dramatic. Okay, I would use it as a buy the dip opportunity. All right, as we go into the month of August. Now, July is traditionally one of these worst trading months of the year. And then out of July, you get August. So back to back, they're both not very good trading months. But if we get the U.S. fiscal stimulus package done in early August, remember they're supposed to go on recess August the 6th. That would be Congress, and then everybody, all these politicians take their vacations. But if they don't have something done, I suspect they'll say here. So the only thing that can motivate our politicians here is not the fact that they can help folks out or help the economy out, but it's if they can cut their vacation time. If you start cutting into their vacation time, then they're going to want to do something. Unfortunately, sorry and sad, but it's true. That's how it works. So I say near term, we're having a heck of a time getting up higher. That fiscal stimulus could move us up, make new all-time highs, and then we're going to run into a brick wall, guys. We're just going to run into a brick wall. And then all eyes are going to be focused on the pandemic and how we're going to handle that and what the number of cases are. I think even though cases are going up, we're starting to reach an apex. And you'll see over the next couple of weeks the number of cases going down as well as the death rate. That will help the markets. A new fiscal package will help the markets, but near term only. Okay. Now we're not in silly season until September. That is when we get into the 60 days before the U.S. Presidential elections. And believe me, this year it is going to be batshit crazy silly season. So members, we're going to want to trade that. We traded the Trump Clinton. We're up at 2 in the morning trading that, and this is going to offer us ample opportunity as well. So just stand by on that. I think it should be pretty interesting how the markets are going to move and what they're going to do. All right. So let's just watch it real closely and see how things shake themselves out. Now I'm going to shift the screen over a little bit again. Let me just take us over, and I've got this index that I've created. You may have seen others do the same thing. You can do it in Thinkorswim if you want. It's not hard to do. But I call it the FANG plus Microsoft index. And I'm going to wait for the screen to paint for you. But if you look at this, what I've got on here is an index that's been adjusted based on share price of Microsoft, Facebook, Apple, Netflix, Google, Amazon. And you can see here where we're not at all-time highs. Okay, you can see the all-time high on this FANG plus M index was around July 13th. So about 20 days ago almost. But you can see that candle there. Now that candle looks like a gravestone doji, right? I mean, it's just sitting here like this, which suggests that we're nearing a peak, and if this rolls over, then that is going to support the thesis of the equity markets just showing tiredness and a little bit of a pullback here. Now, as we roll into August, again, if we get that fiscal stimulus, which we should expect in the next 5 days, that could propel us higher, but then that would set us up for a pretty good divergence on Nasdaq or the FANG index or both, which we haven't seen yet. And if Nasdaq pulls back a little bit harder, then it's going to affect the S&P 500 pretty good little bit. Okay. And of course, if we look at volatility, let me put it on VIX here. You can see the VIX came in for the week. I mean, the VIX for the week was lower just by a little bit, right? It came back in, and you could see here we're right down in this area down here. We've closed out the week at 2446 for the VIX. So, but we're still in a very elevated zone. As I mentioned to you guys, once volatility got back up where it was earlier, then the odds favor vol to stay up for about 6 months or so, and that's what we're going to see. Okay, this was the spike right here when I had our members getting into some long puts, and this turned out to be a real nice trade for us. So now if we look at volatility, you can see where we're sitting at this point in time. And then of course, if we come over and look at Treasury, let's look at the bond market. I mean, if we take a look at the bond market, it finished the Friday up just a little bit. Let's zoom out. You can see how we're in this tight range right here. As I said, for options and derivatives traders, trading for us in this, I mean, it's perfect to use flies. Use butterflies in here. You can do unbalanced flies, and they're really great. I've got probably about 8 to 10 hours of sessions on unbalanced flies and how to trade them, not only with Reg T margin, but with portfolio margin as well. And we've got a number of different variations to it. And I'd highly encourage you to come in and check it out, or just check out in our group, because this is a high probability trade and it does fairly well in these kind of markets, especially erratic markets. So you can do the same thing off SPX as you can off the bond futures. So that's kind of what I'm looking at in bonds. And we look at the 10-year interest rate. Look at this same thing. You can see here we've been in this very tight range, and we just went below, and you can see we closed the week at 536. That's not a good sign, guys. And you can see this prior low right here, which was, it came in at 54.3. So we made new lows that we haven't seen since March 9th, when the markets came unglued. The lower we go here, the harder it's going to be for the S&P to perform. This is the debt market telling the U.S. markets that it just does not believe the strength of the U.S. market, even though they're putting a lot of money in and propping it up. Underneath, there's not a lot of strength. So my word for everybody is extreme caution right now. Okay, that's kind of what we're seeing. And then, of course, if we look over at currencies, look at the dollar. I've talked about the dollar really just coming down dramatically. Look at that. And in fact, every time I do it, I've got to move we made new lows on Friday with the dollar, and then it looks like we had a little bit of a bullish engulfing pattern, not quite, but almost. That would suggest the dollar's going to move up a little bit, but remember, we're sell the rally in the US dollar right now. And if we go to the euro, it's just the opposite. We're a buy the dip in the euro. If I move this up like this, you can see right here, I would like to see the euro pull back into around 115, 116 area, and then I'd be an active buyer. There is no divergences in the dollar or the euro, so it does suggest this is going to go higher. I mean, it's amazing. When you go back to the middle of May, the euro was down around 107. Now it's at 119. Folks, that's a huge, huge move. I mean, just really phenomenal. And we haven't seen this in a decade or so for the dollar euro pair. So this is really just amazing. And of course, there's a number of different ways to trade this. We're going to talk about it this Sunday evening, assuming I don't lose power with this hurricane down here in southern Florida. Should be an interesting session. Okay. Now, if we come down here and look at metals, well, gold is just one of those kind of things. It's just a gift that keeps on giving. Let me move it up again. Again, you can see here with gold, for those that didn't get in on gold, I wouldn't chase it up at this level. It actually broached on Friday the 2000 level, and then it closed Friday at 1994. Any pullback is going to be bought with gold. Now, gold with low inflation, low interest rates, and a weakening dollar, everything is just the sun and the moon and the stars is lining up for gold to be long. And if we look at silver, which is the one that I've encouraged our members to play more than gold, silver, all it's doing is playing catch up. Silver is just on a tear. On a relative basis, silver is outperforming gold dramatically. And back over here was when I had suggested in early April, you want to be long silver versus gold. I mean, we've been talking about this with our members for about almost 2 months now. Silver is the place to be. Okay, now that we've taken out this key resistance level, a little bit of a pullback to that level can be expected, but longer term, we want to be long precious metals. Now, the other one that we were long in is copper. We got long copper back here also in early April, and it's just been a great ride. Now, this is copper futures. Any little bit of a pullback here, a little bit more of it's going to be a little bit of we're in an accumulation or a consolidation mode right now, and then that's going to kind of determine where we're going to go from here. But these have been great trades. So if you're not in our group, you're missing out on some really cool things that we're seeing in the commodity market, in the equity market, as well as the interest rates and the currency market. These are just good trades. And then of course in energy, we've got some good trades going on in energy. You can see it's gone nowhere. I mean, if I blow this up, even if I blow it up here, look at the tight range of oil. And we've got a little bit of a balance right now going on in the commodity space in oil. It's varying just a little bit, but not by much. And we're staying within about a $4 or $5 barrel range. Trading that with selling premium but keeping a tight spread, doing it as spreads versus naked, it makes a lot of sense to me in the oil market. Now, we've also been directional oil. We got directional oil back in early April, and it's just ridden this up really nicely, but not in oil futures. But we've ridden it up mostly in the way to trade oil. There's a number of different ways to do it. I'll review it with our members again this weekend, but this is another one that you want to play. Okay. Now, if we look at natural gas, you can see here with nat gas, let me just get this on the screen. Nat gas, every time it gets down here, we're doing bull puts, right? That's a bull put spread where it's a credit spread, and we're just playing it where it's not going to come down to this level down here. So we're in this kind of wide range here. We're trading the range, right? So that's a little bit about how we're making that play. Now, there are other interesting trades and other equities that I'm going to show and review with our members this weekend, where I see there's going to be some really great opportunities. We're going to be putting on some new trades in Amazon, probably in SPX this coming week. There's some great opportunities there. If you're not a member, I highly encourage you to come in and follow us. We're doing very well in the markets. And for you members, I will see you this Sunday evening, assuming I don't lose power. Have a great weekend, everybody. Members, I'll see you Sunday evening. Take care, everybody. Ciao.